Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden in plain sight within company filings, so you don't have to go through dozens of pages of legalese to get the real story. Today we are diving into what might look like a mountain of paperwork from Franklin BSP Lending Fund, a company that is essentially a lending machine for middle market businesses. But within this filing, we are going to find out exactly how they are making their money, what risks they are taking, and if these investments are really worth the hype. Before we start, if you appreciate understanding the real financial health and strategy of companies like this, make sure you're subscribed. We also have a fantastic Discord community linked in the description below where we dissect filings and discuss market trends. Let's get into it. Franklin BSP Lending Fund is essentially trying to make money by lending to mid-sized companies that might not be big enough for traditional banks but need capital to grow. They are an interval fund, which means they offer quarterly opportunities for investors to sell back shares, but it is not like a regular stock where you can just sell anytime you want. Think of it as providing some escape hatches, but not a revolving door. Franklin BSP Lending Fund is offering 5 different classes of shares: Class S, Class D, Class M, Class I, and Class R6. Each class has different fee structures and availability. For example, Class S, D, and M shares might have transaction fees charged by financial intermediaries, up to a 3% cap on net asset value. But notably, Class I and R6 shares are exempt from these intermediary charges. This is a common strategy to cater to different investor types and channels. The key takeaway here is that the share class you choose can significantly impact the costs you incur. Now, this sounds great up front, no immediate sales load, but let's look closer. While the fund itself doesn't charge an upfront sales load, the fine print reveals that financial intermediaries like brokers or advisors may directly charge you transaction fees. For Class S, D, and M shares, they can charge up to a 3% fee based on the net asset value. This is a crucial detail. It means that even though the fund appears load-free at first glance, you could still be hit with significant fees depending on how you buy your shares. Class I and R6 shares are spared from these intermediary charges, reinforcing that they are designed for larger or institutional investors. Then there is the early repurchase fee. If you decide to sell your shares back to the fund before the 1-year anniversary of your purchase, you face a 2% penalty. This fee is designed to discourage short-term trading and encourage long-term investment, which aligns with the Fund S strategy of investing in less liquid assets. This fee is retained by the fund to benefit the remaining shareholders, essentially by reducing the Fund S overall expenses. Let's talk about the ongoing costs. The fund pays its manager, Franklin Templeton Fund Advisor, LLC, an annual management fee of 0.75% of the fund, S net assets. This is a standard fee for asset management. Beyond that, there are other expenses which include professional fees, administrative costs, transfer agent fees, and custodian fees. These can add up. However, things get interesting with the expense limitation agreement. The manager has agreed to waive fees or cover expenses to ensure that certain annual operating expenses, excluding some specific items like interest taxes and borrowing costs, do not exceed 0.25% of the fund's average daily net assets. This is a crucial safety net for investors. If the Fund S operating expenses creep too high, the manager steps in. But there is a catch. The fund agrees to repay the manager for these waived fees and assumed expenses later on, provided it does not push the expenses over that 0.25% limit at the time of repayment. So, while the manager absorbs costs now, these could still come back to the fund and its investors within 3 years. This agreement is set to last for 1 year initially and can be extended. Now, let us jump to the financial tables where the real story usually unfolds. Looking at the shareholder transaction expenses, we see the maximum early repurchase fee is 2.00%. This matches what we discussed, a penalty for early exit. Now, let's focus on the total annual expenses after fee waiver and your expense reimbursement. This is where we see the real cost of investing in different share classes. For Class S shares, the total annual expenses after the waiver are 1.86%. Then for Class D, it is 1.26%, Class M is 1.51%, and Class I and R6 shares are the most efficient at 1.01% each. This clearly shows a tiered structure where larger investments or specific channels lead to significantly lower ongoing costs. Let us look at the examples to put these percentages into perspective. Investing $1,000 in Class S shares and assuming a 5% annual return, you pay about $19 in expenses in the first year. For the same $1,000 investment in Class D shares, it would be around $13. And for Class I shares, a mere $10 in the first year. Over 10 years, that difference really adds up. For a $1,000 investment in Class S, you pay $242 in expenses, while for Class I, it's only $153. That is almost a $100 difference just on a $1,000 investment over a decade, solely due to the expense ratios and fee structures of the different share classes. So, what exactly is this fund trying to achieve? Well, their main goal is to aim for what they call risk-adjusted returns with steady income. They want to get a good return for the amount of risk involved and also provide consistent income. To do this, they are focusing on private debt opportunities. That means lending money directly to middle market companies in the US, generally companies with EBITDA between $25 million and $100 million. They plan to invest at least 80% of their assets in debt. This debt can be secured, like senior secured or unit tranche debt, or unsecured, like senior unsecured or subordinated debt. The fund will primarily invest in directly originated corporate loans, but also in broadly syndicated loans, collateralized loan obligations, and high-yield corporate bonds. Essentially, they are positioning themselves as a go to lender for companies that need capital and are willing to pay for it, filling a gap left by traditional banks. The sub-advisor, Benefit Street Partners or BSP, sees a big persistent opportunity because middle market companies often struggle to get credit from traditional sources. Banks have pulled back due to regulations, and BSP believes they can step in with their expertise and networks to provide that capital. They are targeting what they call non-competitive strategic capital opportunities, which means deals where they can have more influence over the terms and perhaps get better risk-reward profiles. But investing in private debt comes with its own set of risks. The fund may invest in illiquid securities, meaning they could be difficult to sell quickly without taking a substantial loss. This is a major point for investors to consider. The fund's success heavily relies on BSP's expertise. If key people leave BSP, it could significantly harm the fund's ability to achieve its goals. This highlights the importance of the management team. When it comes to distributions, the filing is clear, payments are uncertain. They might pay out more than they earn, meaning some distributions could be a return of your original investment, not profit. This can lower your tax basis and reduce the funds available for future investments. This is a big one for risk. The fund is classified as non-diversified under the 1940 Act. This means they can invest a larger portion of their assets in a single company or industry compared to a diversified fund. This concentration amplifies risk. If one industry or company they're heavily invested in faces trouble, it could disproportionately impact the fund, its overall performance. In fact, one of their fundamental policies, interpreted broadly, may allow them to steer clear of industry concentration limits, but they also have policies that try to prevent significant investments in any one industry. This could be seen as a point where their strategy might lean towards higher risk for potentially higher reward. The filing doesn't shy away from the risks. It states that investing in their shares involves a high degree of risk and that the US capital markets have seen extreme disruptions. They mention global economic, political, and market conditions as major concerns. This includes volatility, uncertainty in government spending, and the potential for market instability. They are especially concerned about the impact of rising interest rates and fears of a recession, which can affect valuations and liquidity. They also specifically cite ongoing global conflicts, like the ones in Eastern Europe and the Middle East, as potential risks that could disrupt economies and negatively affect their investments. This shows they are aware of geopolitical factors influencing the market. When they talk about their investments, they are very direct. Their investments in portfolio companies are risky, and you could lose all or part of your investment. They detail risks associated with first and second lien senior secured loans, highlighting that collateral values can decrease, and in bankruptcy they might not get fully repaid. Mezzanine debt investments are even riskier, being subordinated and often unsecured. They also plan to invest in junk bonds or below investment grade debt, which carry higher credit and liquidity risks than more highly rated debt. Let us look at the schedule of investments, which gives us a snapshot of what the fund actually holds as of the 31st of August, 2025. The total investments are listed at a value of approximately $65.1 million. Interestingly, the total investments in percentage terms is 121.7%, while liabilities in excess of other assets are 21.7%. This implies they are using leverage, which magnifies both potential gains and losses. Their cost for these investments was about $50.9 million, meaning these investments have appreciated. A massive 87.7% of their portfolio is in senior secured first lien debt. This is generally considered the safest type of debt within a company S capital structure, meaning it gets paid back first if the company runs into trouble. Within that senior debt, a huge chunk, 76.7%, is in bank loans. These are loans made directly by banks or other financial institutions to companies. The top sectors for these loans are business services, consumer, financials, healthcare, industrials, and transportation. For instance, they hold a term loan in Corporation Service Company, and if you look at the rates for the CPI Holdco B LLC loan, the rate is 6.316%. This means for every $1,000 invested, they are earning about $63 annually. But remember, this is before all the Fund S expenses. They also have a significant loan in Modern Wealth Management with an interest rate of 4.500% plus a floating rate tied to SOFR. This structure means their income from these loans will fluctuate with market interest rates. Beyond senior debt, they have 7.5% in subordinated debt, which is riskier because it ranks lower in priority for repayment. This is mostly in corporate bonds and notes across various sectors like energy, industrials, and technology. Interestingly, they also hold a significant 26.5% in short-term investments, specifically in Western Asset Premier Institutional Government Reserves. This is a conservative allocation, likely held to manage liquidity, fund operations, or meet repurchase obligations. This large allocation to short-term, presumably more liquid assets also supports the possibility of leverage, as these can be used as collateral or to fund other operations. Now, let's put it all together for our takeaway. Franklin BSP Lending Fund is playing in a space with clear opportunities, especially in lending to the middle market where traditional banks have withdrawn. Their strategy of focusing on private debt, including senior secured loans and some subordinated debt, aims for attractive risk-adjusted returns and consistent income. The tiered share class structure means costs can vary significantly for investors, with institutional classes being much cheaper. The expense limitation agreement provides some insulation against rising operating costs, but the potential for future repayment of waived fees exists. However, the risks are substantial. The fund is non-diversified, meaning concentrated bets can amplify losses. They are investing in potentially illiquid securities and below investment grade debt, increasing credit and liquidity risks. Their heavy reliance on BSP's expertise means key personnel departures are a serious concern. The fact that their total investments, leveraged and unleveraged, exceed 100% of net assets as indicated by the 121.7% figure in the schedule of investments shows they are using leverage, which, while potentially boosting returns, also significantly magnifies losses. They are clearly aware of the market volatility, geopolitical risks, and economic uncertainties as detailed in the risk factors. The uncertain nature of distributions and the potential for a return of capital are also critical points for investors to understand. In conclusion, Franklin BSP Lending Fund offers a targeted approach to a potentially lucrative, yet risky, market segment for sophisticated investors who understand the impact of leverage, illiquidity, and sector concentration, and who are comfortable with the fees associated with their chosen share class. It might be an option. But for the average investor, the risks, especially without the benefit of daily redemption or a developed secondary market, are considerable. Their strategy and execution will be heavily dependent on BSP's ability to navigate these complex and volatile markets. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out our Discord community in the description for even more insights. Thanks for watching. See you next time.